Greetings, everybody. My name is Alex Moss. I'm the course director for this MSc in Global Finance at the Business School. And I'm also director of the Real Estate Research Centre and teach the real estate module, the Global Real Estate module, which is one of the 12 that you're doing. And in this webinar, what I want to discuss really is some of the issues facing global real estate investors and occupiers in the current environment. And how really the online course enables our students to deal with these challenges. And the way I'm going to do that is by looking at how the sector has evolved really, and looking at some of the historic sort of investment axioms that people have typically ascribed to the sector, and then having a look at whether they're true or not in the current environment, and looking at some of the challenges that people face, and in particular, seeing how we can use the framework for all that you will have learned throughout the course and all that you're being taught in terms of the concepts to apply not just to global real estate, but to other sort of issues that you face and other problems that you'll be needing to solve. So how the course is really helpful in applying those concepts to the real world. So if we move on now to what is basically the way that real estate has always been thought about. And effectively, there is a whole series of sort of evidence that people have pulled together over the last 40, 50 years. Commercial real estate, broadly speaking, started post the Second World War in a major way in the UK and the US. And it's been a lot more recent in some of the emerging markets. So we have a lot of evidence for developed markets and over the last 40 years. And because of that, there's been a lot of sort of maxims or assumptions about it that people have said. And some of those are normally sort of espoused by people who aren't real estate people. But let's have a look at the three of them to start with. So the first one is that, and I'm sure you'll have heard of this, and I'll deal with it in a couple of seconds when we move on. Location is the key to performance. An asset is a tangible building, so therefore location is the key to its future performance. Intuitively, that seems broadly reasonable, but then let's have a look at how that's evolved over time. Property is a local business. Now, this was normally the mantra of all the local agents, but one of the reasons for that is that local knowledge is very important when looking at a real estate market. So you wouldn't expect somebody with knowledge of the Chicago industrial market, which is very large, by the way, the Chicago industrial market, to be able to advise you on buying a UK shopping centre. So to that extent, we'll see whether that still holds true from the investor side as opposed to the agency side. And the third thing that people often talk about is when they think about the listed sector, which is the most, if you like, the most visible and transparent form. And obviously within real estate, we have a very special area, which is called REITs. And they are the listed sector for global real estate. It's about 3 to 4% of the overall equity market. And a lot of people think that they are just equities, not real estate. So we'll be examining that assumption and whether that still holds true. So let's have a look at all of these three and see how they worked out over time. So in terms of location, if you go into a dusty old library, if anybody remembers what a physical library is, or more likely search online, you'll probably see a whole load of old textbooks and the rest of it. Again, they're in typical sort of general investment type things, saying that property is all about location, location, and location. Whilst that may have been true, that has evolved quite significantly. So in the run up to the global financial crisis, and one of the things we do in the course is break down all the periods of the last 20, 30 years into elements of a cycle. And that period of 2000 to 2007 was effectively an uninterrupted bull market, the irrational exuberance as teamed by Alan Greenspan. So in that period, the run-up was no longer about location, location, location. Effectively, it turned, the letters stayed the same, but it effectively turned into lunch, leverage, and luck. And what do I mean by that? Well, the first point in terms of lunch, effectively, because real estate is a bilateral transaction business. In other words, the whole valuation system is based on one willing buyer and one willing seller. So it's a bilateral transaction. Equities are obviously many people transacting all at the same time. So with real estate, it's one buyer and one seller. And what that means by definition is you need the context to acquire the assets. You could have the best looking spreadsheet and the best investment analysis in the world, but unless you actually own the asset, it's not going to do you much good. So the first point is you needed the contacts to actually acquire the assets and indeed to sell them later on. So networking, which we'll call it, which in UK and Europe normally involves a rather nice bottle of wine, not so much in North America, but networking is a very key part to it. So lunch I've put in there as the first L. And then the second L is absolutely key to understanding how real estate works, and that is the impact of leverage. So one of the things we do a lot on the course, and you should be well aware of, is the impact of leverage on a single financial asset, how leverage juices up the performance over time, and in particular, what the impact of a leverage structure is on a fund or a REIT, etc. So an asset, the same asset, will perform completely differently in terms of the investor returns if it's held in a leveraged REIT or an unlevered fund, and we'll go through what all that means. So leverage was absolutely the key to performance then. So that's the second L. The third L, in investment management terms, we sometimes call this alpha, but actually, some people might call it luck or market timing, and that is effectively being able to buy at the bottom and sell at the top. In other words, so the key to real estate in terms of cycles is always selling out at the top and then reinvesting back at the bottom, because it is a cyclical business. And what the aim is normally is to sell out to what's known as the leveraged tourists, who are overseas buyers coming in right at the top of the market, who typically buy from local investors, and then quite often, not always obviously, but quite often the cycle starts all over again. So that's how location has changed to lunch, leverage and luck pre-GFC. Post-GFC, we faced a very different set of problems, and particularly now with the impact of COVID-19, we face a different set of problems indeed. And if you were to ask an investor in a vehicle what the single most important thing for that vehicle to have, that asset owner to have, it would be liquidity. Why is that? For two reasons. Firstly, to be able to withstand any value falls and remedy those breaches of covenant with its bankers. But most important, and this is absolutely the single most key change between what's happening now in 2020 and what happened during the global financial crisis, now you actually have a situation where the tenants aren't paying the rents. During the GFC of 2007, 8, 9, and actually going through to 10, most of the tenants still paid the rents, but actually it was the capital values that were a problem, because it was effectively a liquidity crisis rather than economic crisis. That came later. So here we're faced with an economic crisis where the top line, the rental income of a building, is not coming in because the tenants, for example, in a shopping centre, aren't paying the rent because people aren't going into a shopping centre, etc. And what's the impact of that? Well, the impact is incredible, because if you look at the table that I put there at the bottom, this just shows you for the UK, but it's illustrative. Rents are paid quarterly in advance, typically on what's called a quarter day, and the last two we saw in March and June. And as you can see, under 50% of tenants paid their rent in the retail sector, and about 3/4, just under, paid in the office sector. But actually, interestingly, in leisure, it was only around a quarter. So that impact on your income is extraordinary. That's just a straight haircut of 50% or 75% to your top line, and that affects how you're going to run the business. So what comes out of this is absolutely key to understand how the capital structure of the asset owner affects the performance. And that's true from both the manager's point of view and also from the investor's point of view. And that ties in with other things that you've learned on the course in terms of investment strategy, financial statement analysis, etc., etc. So let's have a look now at the second axiom that people have said, and that is that property is a local business. Well, that might have been the case, but certainly isn't the case anymore. And again, I mean, in the UK, it was broadly until the early 90s that it was a very domestic business, and globally, it has become a global business post the GFC. How do we measure that and how do we know that? What we tend to look at are the volume of transactions, the volume of investment transactions, and then we look at the volume of investment transactions. There's fantastic data provided by Real Capital Analytics, RCA, which tells us what the source of that volume was. So in this case, I've shown you a chart where the blue represents, this is the UK central London office market. Blue represents domestic buyers, and the other two represent global or continental European buyers. And as you can see, broadly speaking, over the last 5 years, domestic buyers have only accounted for about 20 to 30 odd percent of the market. The balance, i.e. the vast majority, has been an overseas buyer. What does that mean and what's the impact on pricing? What that means, and again, this is something you've been taught in the course in modules before you get to the global real estate one, there's effectively a global cost of capital. So in other words, an investor will look at a London office building, and we've seen this with, we like to name our buildings after either kitchen appliances or various other things in the UK. So the walkie-talkie and the cheese grater were two buildings in the UK, which are big office buildings built post-GFC, which were sold to overseas buyers. Those sorts of buildings, and indeed the Gherkin, which is sold to a Brazilian bank, those sorts of buildings, high-profile skyscraper buildings, are priced in terms of the buyer relative to what they could buy in their local market. So in other words, that, and the same with Broadgate, those buildings are cheap in terms of Hong Kong yields, which is where the buyers originated from. They may seem quite expensive relative to domestic buyers. And what's happened is that you've seen there that domestic buyers have been priced out of the local market and overtaken by overseas buyers. And one of the implications of that is that the higher, and this is something RCA talk about quite a lot, the higher the level of an overseas buyer as a percentage of a market, the riskier the market. So if it's over 50%, it becomes risky. What does that mean? If you look at that chart, because effectively, when there's a problem, be it a global pandemic or the EU referendum or global financial crisis, when there's a problem, the first thing that overseas buyers tend to do is to go back and repatriate the capital back home. So actually, if that market is being priced off overseas rates and then is suddenly priced off domestic rates again, there's a recalibration of values. And that's, broadly speaking, one of the things that's happening at the moment. And that's a key point about this course. We are talking globally, so you need to understand the global interconnectedness of both capital flows and also occupiers. I've talked a little bit here about the investment side. This, of course, is also true for global occupiers, for people like WeWork, etc., or global retail tenants. So the key point is, within this whole idea about global real estate, what we teach you on the real estate module is how to value a building, because it's a bilateral agreement, one buyer, one seller. That's a different valuation mechanism from valuing an equity or a bond or a derivative. We teach you how to value a building, how to finance it, how to value a REIT, and also how to allocate real estate within an overall multi-asset portfolio. And then moving on to the third point, which people quite often say when they talk about the listed sector, which, as I say, is the most visible and transparent element. They typically say, well, listed sector, that's not really real estate, is it? It's just subject to the vagaries of the equity market on a daily basis. Prices go up and down, 5 to 6% a day, et cetera, et cetera. And they follow a random walk, so it's unlike the nice smooth path of real estate, appraised real estate values. Well, if you look at this chart, what's interesting, and this is from EPRA, who provide fantastic information about the listed sector, both on a European basis, because they're the European Public Real Estate Association, and also on a global basis. If you look at this chart, what this tracks is the yellow line is, or is it yellow, orange? The yellow orange line is effectively the underlying value of the buildings, the NAV, and the blue line is the share price. So as you can see, and that's why I always think that this shows up much better in graphic form than in a tabular form with statistics and 3 asterisks. This shows you very clearly two things. Firstly, how the blue line, the prices, very clearly track the values. So in other words, you won't get a successful listed real estate company if the values of the buildings aren't improving significantly. So if the underlying real estate is not an area that people want to invest in, it's unlikely that the listed share price is going to perform well. The second thing that comes out very clearly from this, and you can see this on a couple of occasions, is how the blue line, which is the share price, effectively already anticipates changes in values, particularly at what we call inflection points. And as you can see most recently there, share prices are assuming a big decline in property values, which is now just starting to be realized. So two things really. The listed sector very much is part of the real estate sector, and it correlates very closely with the underlying values. But most importantly, even if you're not going to have anything at all to do with the listed sector and just want to work in real estate full stop, you should take account of the listed sector, because it's a very good what we call leading indicator of values. And now is a particularly relevant time, and you can see how that is anticipating the fall in values, which is now just starting to come through. So if we go on to the next slide, and we can then see a little bit about current trends and where we are in terms of valuations. One of the things that you can see from this chart is very clearly, this shows, by the way, what's called the discount to NAV. The line across the middle is if share prices were trading at exactly the same value as the value of the buildings, that's called NAV, or trading at par. That's 0% premium and 0% discount. That's where they're trading at the same value. If they're trading below the line, the share prices are trading below the value of the buildings. If they're trading above the line, they're trading at a value above the value of the buildings. And what this chart shows you very clearly are two things. Firstly, and this is broken down into the different sectors of retail, office, industrial, residential, and diversified. And what this chart shows you very clearly is that until sort of 3 years ago, broadly speaking, the sectors moved as one. So you could think about it as there's one commercial real estate market. So you're investing in a sector. Does it really matter if you're an industrial, retail, etc.? That chart would tend to suggest, in terms of the pricing, not so much. There's a little bit of nuance there, but not so much. What you can see very clearly over the last sort of 3 years is the fact that you've had this huge divergence of performance. And when I say huge, I'll just quantify that. So the top line, the blue line, logistics, which is what everybody wants, logistics, which are the big industrial units, the big boxes, 500,000 to a million square feet. When you click on your Amazon phone, a little robot goes around and picks it out there, puts it on a conveyor belt, somebody packs it, and off it comes, delivered to you later that day or the next day. Those big assets are exactly what people want, along with last mile delivery, as well as standard sort of multi-let industrial units. Those assets, the listed companies, they are trading at a value of 30% above the last stated value of those buildings. Why is that? Because people think that those buildings are going to continue to go up in value. If you do ask people now, and I think the last 6 months have demonstrated very clearly this impact, what is the one trend that you think people will sort of continue to go for? I think home delivery is a broad concept. It'd be hard to argue globally that home delivery wasn't going to continue to go up. So that's why industrial companies, people like Segro, Prologis, Warehouse REIT, all those companies who own those assets, they are trading, the share price trading 30% premium because it's anticipating future changes in values. That's one side. The other side of the coin is that those companies that own shopping centres, the retail sectors, are trading at nearly a 70% discount to NAV. So if the NAV of Prologis was 100, they'd be trading at 130. If the NAV of Hammerson, for example, was 100, they'd be trading at 30. So a huge discount to that. Why is that? Because people believe that retail property values will continue to decline, because the retailers, nobody's going to shopping centres. Well, they've just reopened, but they may have to close again. They're struggling to pay the rents. They face the challenge of online, etc. So the point about this chart is there's been a huge divergence in performance, and that's priced into the listed sector. And that's why the listed sector gives you a very clear leading indicator of what is expected to happen to property values. And that's the big trend that we're seeing at the moment, this divergence of performance. So to wrap up and to sort of summarize, what do we do now? How do we deal with all this? Well, the answer is that in terms of trying to understand the impact of rent loss through COVID-19, the difference in performance between different sectors of the market, the globalization impact, etc., what we need is to have a very sort of global holistic approach rather than a single sector methodology, which is why everybody in real estate needs to understand all about the global capital markets because they're influencing pricing. And in particular, those pricing signals that we're seeing from the equity markets and the bond markets are all used as leading indicators. So effectively, potential buyers or sellers of building are looking at those for where they think those assets might be transacted. Finally, I really want to emphasize this point about understanding the impact of vehicle leverage and optimum capital structures, because what it means is that if you understand the difference between an open and a closed-end fund, a leveraged finite life fund, and a listed REIT, and how they operate, you'll understand what their requirements are, and you'll understand how the same building will perform differently under their different ownership. So that's very important. And in addition to which, now, because forecasts are hard to make, we're looking towards a much more implicit pricing model, and that's one of the skill sets that we teach. So overall, the concepts that we talk about within the Global Finance online course are all here. This is a brief example of how we apply them in practice, and they're designed to equip you, the leaders of tomorrow. Thank you very much.